What's happening in the markets right now could change everything. Rate cuts, inflation that won't go away, growth that's slowing. If you're trading, investing, or simply worried about your money, you must know this. Let's dive into the finance update for September 2025. What's driving the market, what to expect, and what moves you might make next. First up, the US Federal Reserve just made its first interest rate cut of 2025. They lowered the benchmark rate by 25 basis points, bringing it down to 4.00 to 4.25%. Reuters +1. What's behind the move? Weakness in the labor market is a big driver. Unemployment is creeping up. Job growth is slowing. Signs that the economy is cooling off. Reuters +2, the Washington Post +2. Inflation remains elevated though. US inflation jumped to about 2.9% year over year in August, with core inflation, excluding food and energy, holding near 3.1%. The Guardian +2, Trading Economics +2. So the Fed is facing a balancing act. Cut rates enough to support jobs and growth without letting inflation run away. It signals 2 more rate cuts for the remainder of 2025, October and December, according to many forecasts. The US isn't the only one moving. Let's look globally. Hong Kong lowered rates by 25 basis points to 4.50%. That mirrors the US Fed's move, since HKMA's policy often tracks the Fed due to the currency peg. Reuters. Brazil is keeping its interest rate very high. The Selic rate remains at 15%. Inflation in Brazil is still well above target, approximately 5.13%, so the central bank is staying hawkish. The Wall Street Journal. In the Eurozone, the ECB held its rate steady, around 2%, and is using a wait-and-see approach. Inflation is creeping above target again, approximately 2.1%, and growth is still sluggish. Financial Times. Overall global growth is being revised downward. According to IMF and others, world GDP growth for 2025 is now projected to be around 3.0 to 3.1%. Modest but under pressure from trade barriers, political risk, and inflation. So how are the markets reacting, and what are the risks and opportunities? Equities, mixed signals. Some sectors are performing well, especially those benefiting from AI, technology, and automation. But others, like retail exposed to tariffs, consumer goods, and interest-sensitive sectors, are more volatile. Bonds and yields. The 10-year US Treasury yield is trading between 4.0 to 4.5%, with many expecting it to end the year nearer to approximately 4.35%. ONG yields won't fall much unless inflation drops and growth slows materially. Safe assets and commodities. Gold and oil remain firm. Oil benefits from geopolitical risk and supply constraints. Gold is being supported as a hedge against inflation and uncertainty. Here are the major risks that traders/investors need to keep an eye on. Inflation persistence. If inflation refuses to drop closer to the 2% target, central banks may have less leeway to cut rates, or may even reverse course. Labor market softness. Higher unemployment, declining hours, or other negative labor trends could force more aggressive easing, but that comes with its own costs. Tariff and trade risks. Tariffs are feeding inflation, causing uncertainty in supply chains. Any escalation could hit margins and consumer prices. Policy uncertainty, political pressures on central banks, fiscal deficits, budget policy. These all create risk. For example, in the US, political comments have already created tension around the Fed's independence, geopolitical and global events, energy supply disruptions, China policy, war risks, always able to throw off forecasts. Given this environment, what strategies might make sense? Here are some ideas. Diversification is key. Don't put all your eggs in one sector. Mix inflation-hedged assets, like commodities or inflation-protected bonds, with growth stocks and defensive stocks. Focus on cash flow and dividends. Companies with strong cash flows or dividends tend to do better when overall growth is weak. Watch the yield curve. If the long-short yield spread flattens or inverts, that could be a warning sign of a recession ahead. Keep some dry powder. If more rate cuts happen, as many expect, there may be buying opportunities. But being opportunistic and patient is important. Global exposure. Emerging markets, particularly in Asia and Latin America, may benefit if US rates fall or if commodities rise, but be wary of currency risk and local inflation or policy instability. To wrap up, 2025 is shaping up to be a year of transitions. The Fed has begun cutting rates, but inflation and labor market risks make the path forward uncertain. Global growth is moderate, not booming, and many central banks are walking a tightrope. For traders and investors, that means volatility, but also opportunity. The questions are when to enter, where to allocate, and how much risk you can tolerate. If you liked this deep dive, hit the like button, subscribe, and drop a comment. What are you watching most? Inflation, rates, or tech stocks? I'll read them and maybe cover them next. Thanks for watching. See you next update.